get their take on the week we've had so far and where we're headed over the coming weeks. David, where's your head right now?
Well, look, I think that the first one-third of this decline in the stock market was really wiping out the excess froth that we had in last year's fourth quarter. And the next third that we had was really starting to price in the rising prospect of a recession. And I think the next third leg down will be pricing in the reality of the recession. So I think, look, a lot of work has been done here, a lot of rupture and damage. I don't necessarily think that a recession's been fully priced in to the S&P 500. You could argue that the Russell and the S&P 600, the small caps, which are down 34% from the peak, that they probably priced in the recession, but the large caps haven't really followed suit yet fully.
What number would do that for you?
Well, it's situational because there's so much uncertainty, but I think if we get a recession, and I think the likelihood is very high right now, just a total disruption of global supply chains and to domestic demand. I mean, this is a supply shock and a demand shock simultaneously, and then layer on what nobody's talking about, but we would be if it wasn't for the pandemic, which is the oil shock. I think the odds are that the recession has already started. It's hard to know how long it's going to be, but if it's a classic recession, then when you look at what the multiple usually does and you look at what earnings usually do, the bottom is going to be somewhere close to 2,200 on the S&P 500.
All right. Liz Ann, where are you? I'm Gary Cohn on CNN this morning saying we're already in recession, in his view. What do you think?
Well, keep in mind that to the extent we get a decision officially declared by the National Bureau of Economic Research, when they ultimately date the start of it, they go back to the peak in activity. They don't go to the point where they discover we're in one. So, yes, if we're heading into a recession, it's probably already started. You know, from a market perspective, in the post-World War II era, there have now been 20 either bear markets using the traditional 20% definition or what I call near bear markets, where you go down more than 19 and stop just shy of 20. And interestingly, there's been 6 or 7 of those. Those that had a recession in close proximity, the average decline was about 32%. Those that did not, 24%. We're sitting right in the middle of that. So the problem, though, is that we've got other factors, including the problems in the credit markets, which the Fed can't directly help, and then what they're trying to do in the Treasury market. So we've had sort of this triple whammy, the virus, oil in the credit markets, and Treasuries. And so far, monetary policy can really only directly aid the third of those.
And Liz Ann, I know you have been focused on the conditions that prevailed when we started here, right? Where you basically had very full valuations and then investor sentiment getting a little bit overexcited January, February. Where are we now in trying to, I guess, unwind some of that on the way to maybe something that's a little more of a represents core value and diminished expectations?
So for sentiment, I think on most metrics, we have seen a complete reversal. You see it in everything from the CNN Fear and Greed Index. If you look at behavioral measures of sentiment, put-call ratio, sentiment trader, smart money, dumb money, confidence indexes, you have completely reversed the extreme. But the valuation problem is a different one. You touched on it. We not only have the P in decline, we've got the E in decline, and we don't have a sense of where the E declines to, not to mention the fact that financial conditions have tightened. That puts downward pressure on multiples. You've got weakness in the credit markets. That puts downward pressure on multiples. And as I often say, as much as we think of valuation as a fundamental indicator, because we can typically quantify the P and quantify the E, at least at some moment in time, valuation is as much a sentiment indicator as it is a fundamental indicator. So if the sentiment shifts, you don't know ultimately where the bottom goes in PE because it becomes a function of what investors are willing to pay, not just the actual measures of the P and the E.